Wednesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, please take a look at the shared disclaimer. Be aware that neither Market Chameleon, Demetri, or myself are registered investment advisors or a broker dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and products. With that, D, good Wednesday morning, my friend.
Good morning, Will. How are you?
Good.
Let me share my screen here. And as I'm doing that, uh, good morning, everyone. Will and I, we do these shows. If you guys are joining us for the first time, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, type it into the live chat on YouTube. Will's keeping an eye on it. He will let me know, read it back to me. I think we do have a question actually from yesterday, Will. So I don't know if we should just jump to that or cover some of the pre-market reporting just to give a couple of minutes for people to join us.
Yeah, we can just everyone can just run it. And I think it was Chris. Was it Chris or
yeah.
Since you asked it, but they can come in and listen. Just so everyone knows, if you don't know already, all of our videos are stored on our YouTube channel. So anyone can come who comes in late can rewatch this episode. So if you think it's going to be a longer episode, let's start it with the question.
I mean, I guess we could just jump to it because we already have that question coming in, and the question I was just kind of
can I just share the screen again, just so we
go ahead.
Yeah, and you can talk about the question.
Yeah, I was just trying to review it as we're starting out. So there's
I think it was about calendar spreads, right? And is there a way to identify maybe the win rate or all right, you can take over the screen.
Okay. So I'm gonna jump kind of to the calendar spreads under our screeners. So under screeners here at the top, you have these different screeners you could choose from, and we developed them to screen, not just for options, but with options you could create different strategies. Right? You could have a call spread, you could have a put spread, you could have a butterfly straddle. So there's a lot of different strategies as a trader that you could utilize using options. Okay, and the question yesterday I think dealt with a time spread or a calendar spread, and I believe it was like a long calendar spread. So that's what I'm going to go here under calendar spreads, debit calendar call spread. Okay, and I think you guys have access to it. Let me know if people say they don't, but I think we pushed the debit calendar call spread out. I didn't cover it yet. Okay, so on this calendar call spread, right, because you could develop a time spread with calls, you could develop a time spread with puts. This one is looking at call options, and a time spread, traditional time spread, will have two different expirations and same strike. Right. So what you're doing in a long calendar spread, you're buying the longer term expiration and selling the shorter term expiration on the same strike. Okay, in a call. In this example, it's in a call. So this screener here, okay, goes through different potential calendar spreads in the stocks, and I think it looks like in each stock it looks at three possibilities. It looks at an at the money strike. It looks at an out of the money strike that's closest to 25 delta, and then it looks at an in the money strike that's closest to 75 delta calls. Right. So for each stock, you'll see Here's a bunch of them in NVIDIA. They probably got close because it has a lot of strikes. But that's what it's trying to do, is saying, okay, look at a couple different strikes as potentials. And the reason behind that is that a at the money strike, right? So there is some potential directional bias in a spread, because you want the stock to finish at the strike price on the first expiring expiration. Okay, that's your sweet spot as far as stock price goes, because if it finishes at that strike, that option that you sold is worthless, right? If it's not in the money, it's worthless. So whatever you sold it for, you just kept all that premium, and now you're left with the longer term option. And when the longer term option is at the money, that's where the time premium is the greatest, right? Because the it's all time premium. It's not, there's no intrinsic value to it. It's not out of the money, so it's all time premium. So from that perspective, if you're bullish on a stock, you'd want a higher strike. If you're bearish on a strike, you'd want a lower strike because you think that the stock will float to a lower strike. And if you're just think that the stock is going to remain at this spot, you'll look at the monies. So it looks at a couple different potentials. When it scans for potential call spreads. So unlike I'm trying to describe this screener before we do screen and what a calendar spread is. So unlike a vertical spread, what do you have? You have two different options, but you have the same expiration, two different strikes. Here, we're going the other way. So you have the same strike. So here's an apple. The strike is, this one is looking at a 245 strike, but you have two different expirations. So this particular apple calendar spread is looking at November 15th expiration and the December 20th expiration. Okay, two different expirations, same strike in the call. And on the right here, 245 strike. So a couple things here, we'll notice before we analyze it, is that there are 24 days between those expirations. Okay, so you got 24 days between the November 15th and December 20th expiration. So after November 15th expires on that day, you'll still have 24 more days for December 20th. That's what this is. November 15th from today has 18 more days to expiration, and December 20th has 42 more days. So these are just reference numbers right now, that we're just providing for quick analysis. And when we talk about calendar spreads, you could have, because there's different time frames, there are certain things that may be covered in one expiration that's not covered in a different expiration, certain events and so forth. So these also become important to start distinguishing. And our question was, well, what about earnings? Okay, so that's what this little e here is. So this little e says that we detected that there was going to be an earnings that is prior to this expiration, meaning that this expiration will cover the earnings event. So as I'm hovering over it, you could see in Apple, we're expecting earnings October 31st after the market close. Well, October 31st comes before November 15th, meaning that if you have the November 15th option and you're holding it to expiration, it's going to cover that earnings event, right? October 31st will come. We're going to have an event, but this expires November 15th. And of course, then December is also afterwards. So both of these options will cover the next earnings. Okay. We still have some days to go, but this is the uh, reference information in this particular strategy spread. Now, let's like come to some of these stats here. Okay, what these stats mean, and how you could use this to narrow down potential counter spreads. So this here is saying that the market price right now of this spread is $2.52. And it's really saying that if you executed this strategy right now on the displayed bid and offer, okay, it's $2.52. That means that there are firm quotes out there that we could reference that you could buy the December 20th at a price call, and you could sell the November 15th price at a bid. It's $2.52. So that's looking at like the executable price, market price. All right. And I think we have the market data here. So you could see here, you have these other tabs to look through. If we switch to the market data, you could see that the market price is 252, but the bid price of this is 237. The ask is 252. So obviously there's some room for price improvement potentially, because there's a spread in this market, 237, 252. You say you got some whatever it is, 15 cents, right, between the bid and offer, that you might be able to get potentially a better execution. You can put in a limit order in there, maybe in between, away from the offer. So that's important to understand. These are looking to analyze a strategy from initially from the of market prices that are displayed. Okay, the executable market prices. So let's come back to the summary here. Now we know that that the market value is $2.52. But our question is, well, what does that mean, from a perspective of, is it relatively high or low, and how do I benchmark that? I need some kind of like frame of reference, is this higher? When we use financial analysis, we need some benchmarks to help us out, right? Some kind of models or benchmarks or averages, something to reference to get us first started. What does this mean in terms of historically, is this like high or low, and how far away? So to create a benchmark, right, to say, well, how far away is to a benchmark, we create this theoretical value. Okay, so that's our first reference number. So we see a theoretical value of $3.21, and then a market value of 252. So we have a sense of, well, if it, in theory, on average, it's worth 321, it's 252, it's below that benchmark. But how do we get that benchmark is also important, because you could create benchmarks, and when we talk about benchmarks and analysis, there's no one right answer, right? There's no one right benchmark. It's just a methodology that you're using to try to calculate, and people could have different methodologies. So we're going to talk about this methodology, okay? And the methodology could include things like, what do you include, what do you exclude, how much data do you include, are there exceptions, all that, what kind of calculations you're doing. But let's just describe this first, this benchmark. Okay, so what this is doing is saying, okay, I know the two expirations, right? So with this strategy, I know that these two expirations, this one has 18 days to go, this one has 42 days to go. And I know that earnings is X amount away. So if I look back into history and say, can you find me a similar situation? Okay, so give me a similar situation where the strike and options with the strike price similar distance away percentage-wise, and with expirations in those options that are similar days apart and left till maturity, and with an earnings that is similar days apart from these expirations, right? So we need to find first a scenario that we could match as closely as we can to this scenario, right? That's what we're trying to do. First, let's see in our history, in our recorded history, if we could find those types of situations. Then we find those situations, right? And that's where this in this open analysis, when we find those situations, okay, like this, we'll say, okay, now that we found it, show me what a snapshot, record of what those two options look like, right? In terms of the implied volatility there, because we need to simultaneously, because we're doing both of them at the same time. What did they look like, in a snapshot picture? Give me data points. So then it goes back in history and says, okay, on this date, we see a similar situation here, so let's open this up. We see a similar situation on July 23rd, so July 23rd had a similar situation here, with you could read this study, that there's an earnings period. It looks at trading days, so not days to expiration, looks at trading days available. So it doesn't, because weekends don't count because you can't trade on the weekend. And so it looks at trading days with similar situation with earnings, days to expiration, and then says, find me those dates. And here it is, July 23rd, April 23rd. And they say, okay, based on that date, look at the date and tell me what was the implied volatility of option number one versus option number two. All right, option number one has less days to go. Option number two has more days to go. What was the implied volatility? 25.7, 23.7. So you could see these are the different implied volatilities. And we'll say, okay, if we used those implied volatilities and applied them to these options today, right? Ignoring like what they are, but if we applied those options, what would this option be worth, number one? And what would this option be worth, number two? And then in theory, what would the strategy be worth? Because now we got the price of both options. What's the strategy worth? So it would be worth 285, 301. So you can see it's not the same all the time. It's going to vary. That's how trading is. You're going to have, fluctuations, and you're going to have, so what we're doing is getting now what are we getting? We're getting the average of those. So that's what this theoretical value is like, well, give me the average of all these. This is going back, I don't know, 4, 5, 6 years. Takes the average of all of them and says, okay, it's 319. Well, the average of all of those, so it's slightly, I think that there's a little bit of a difference between that stored in today's calculator. But what this is saying is that, okay, now I see that the average of all of those so far is above where the current market's trading. And by 67 cents. So theoretically, I'm getting 67 cents extra by getting it below the average, right? If that's how we want to compare it. But then we want to see, well, is is it, that's the average. Average could get skewed higher or lower. What is the low high range? So this is the low high range in our data bank of this strategy, 208 versus 475. Right. So the lowest in here we got was $2.08 at some point, and the highest was $4.75. Okay. So now we could compare that to the 252 and say, okay, well, that seems on the lower range than on the higher range, right? If you're just eyeballing it from like taking the midpoint of that, well, certainly that looks like on the lower range, closer to the lower than the higher. And by how much? So then we could look at it and say, well, what is the percentile rank, right? So let's just say I have this 252. How many observations are below 252? And how many are above, right? So we got the range, we got the average. Now we just want to know how many fall below, how many fall above. So that's what this percentile rank is, 13%. So 13% of our observations were below 252. The rest were above. Okay, so I'm going to close this real quick. So that's what we have here. So this now gives us a general sense of where the markets are priced right now relative to history from a couple different perspectives, right? So, and it could be justified, right? There could be a reason for that happening right now, and that's up to you to kind of investigate those reasons why it's that. Because keep in mind, information, you know, is not constant. It's always changing, and situations are not always exactly the same. Everything about trading is dynamic, and situations change. There's more information. There's things going on today that may have never happened in history. Okay, that we can't even reference in addition to it. So these are always things that need to be investigated and taken into consideration. Right? That's part of trading. So now that we have kind of these benchmarks here, it could help along, to kind of filter things out and quickly make assessments based on these analytics. I think one of the questions were volatility, and you could, if there is a tab here, and if you wanted to just compare, short-term versus long-term volatility, or you could do it this way as well, but essentially this kind of does that. Okay, this does it for you as well. Okay, based on history. It says based on history, where do these similar options tend to be priced? So now that we have that, if we wanted to change the expirations, because keep in mind, with time spreads, you could obviously you could pick different strikes, but then which expirations do you want to use? And there's no right one. This kind of depends on what you're trying to do, your preference, and so forth. So that you have the ability to change these. It's defaulted. I think it's defaulted to. Well, let me see if there is a default. Yeah, so there's a default. It looks like the next two monthly expirations. Okay. Though, if you want to change those, you could change them. There's just a default here to start out with. Okay. Now, if you are looking for a particular type of strategy, let's say you want a calendar spread with earnings, okay, you can use this filter here, earnings dates. So these are the choices we have. We could have in earnings that are after both expirations or none. So something like, if we choose that, we'll say we don't care about that. We don't care, for earnings at all. We want earnings not to be involved in any of these expirations. So, like SPY doesn't have earnings, right? So that will fit here. Certain stocks are not expected to have earnings prior to this further expiration. So this will filter out earnings. right? And then you could kind of focus on other, non-earnings anticipated calendar spreads. Or maybe that's what you prefer in earnings. So here we could come here and say the earnings before the nearest term expiration, which means that uh, it will cover both expirations will be covered, right? So here's an earnings and earnings like we were talking about. So this would say both expirations will cover that earnings event. If you do this strategy and you hold it to expiration for the first one, then the earnings will be covered. You could also say, you know what, I want to do a different type of strat that it's I want to look at an expiration, the near term that will not cover the earnings. The earnings are coming after, but it's before the further one. So let's look at that situation. So here's a situation where ABGO, you see November 15th expiration, and then December 20th. But earnings, look, next earnings we have estimated between December 5th and December 9th. So we don't know yet, but we're estimating based on historical trends that the next earnings appears to be around December. Well, if that's the case, the December 20th will cover that. If it's between December 5th and 9th, if our estimate's correct, then until it's announced, we don't know, but we're basing it off of what history is suggesting. December 20th will cover December 5th and 9th dates. However, December is obviously after November 15th. So what we have is a situation that this time spread, November 15th will expire, but we don't anticipate any earnings in that month right now, right? But December 20th, we do anticipate earnings. So what you're doing is a calendar spread that one expiration, the further one will cover it, the closer one will not cover it. So that's this filter, and that's this scenario here. There is another event that we detected. See this little C? So C says that we detected that the company did announce that they're going to have some kind of other company event that's not earnings. So we put it in there. It could be something to consider because some events, if the company is making an event, they could, reveal a new product. They could reveal something, to an analyst, or they could say something that could make the stock move because it is an event that potentially investors, customers are paying attention, journalists. So it's something to consider in your strategies. But
why don't we stop there and we can follow up from here on tomorrow's episode. Cincy was in who asked the question, so he says he's been listening. If you have any follow-ups for tomorrow, Cincy, just email us, let us know. Great job, Dimma. That was awesome.
Thanks everyone for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.